Warren Buffett became a billionaire on May 29, 1990. Today, at 92 years old, his net worth is over $110 billion. All that by following supposedly simple principles that we all can easily utilize. So, how did Warren Buffett invest his money? Lesson number 1, stay humble. During the financial crisis of 2008, Buffett became the richest person in the world for a year. You would think such wealth would allow for some baller moves, right? Well, it surely does, but not for Mr. Buffett. Throughout his entire career, he has been described as incredibly frugal. He had a flip phone till 2020. He buys quality brands, not luxury brands. And he still lives at the house he bought in 1957 in Omaha for $31,500. Obviously, money was different back then. All of that seems to be a part of his true personality. In 2009, he wrote this in a letter to his partners after a failed investment in ConocoPhillips. I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year. I still believe the odds are good that oil sells far higher in the future than the current $40 to $50 price. But so far, I've been dead wrong. Even if prices should rise, moreover, the terrible timing of my purchase has cost Berkshire several billion dollars. Warren Buffett's humility and frugality are clearly visible wherever he goes. And if one of the richest people in the world is about that life, so can we. Lesson number 2, be patient. Young Buffett's mentor was Benjamin Graham, author of The Intelligent Investor and pioneer of the concept of value investing. In simple words, this approach involves looking for companies that are undervalued by the market and purchasing their stocks at a discounted price. As Buffett once said, the market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. Mr. Buffett takes a long-term view at the market and his stocks. He doesn't think of buying shares just as buying a piece of paper, but as buying a part of a business, usually an undervalued one. And you have to give that business time to grow and for other people to notice its true value. That's why you have to be patient. There will be highs, there will be lows, but you don't have to participate in the turmoil of the stock market on a daily basis. You can just use it when it benefits you, serves you. Lesson number 3, forget about the price. Mr. Buffett once gave us a thought exercise. Imagine you have $1 million and within a week, you have to invest all of it into private companies. And you have to hold that investment for life. What would you be doing during that week to make sure that you're investing your money well? That's the investing mindset that Warren Buffett advises us to have. If possible, avoid looking at the prices. And again, forget you're buying stocks. You invest in brands, in people, in patents, in everything that constitutes a business, and not in some numbers on your screen. If you've ever learned about value investing, these concepts may seem obvious for you, but overall, they do go against some investment advice, such as looking at graphs and shorting stocks. If you find them useful, feel free to do more research on the topic, and use them to your advantage, not the other way around.